All right, that looks good. That looks good. All right, everybody, welcome to the SeeWhy Learning Mutual Funds 6-week complimentary bootcamp webinar number 2. So my name's Jason. I'll be your host today. I'm one of the regulatory trainers here and study coaches at SeeWhy Learning. We are very excited to have all of you with us today. Now, just before we dive into today's agenda, I want to take a quick moment and talk about our Investment Basics series of videos that are available for all of you to use on our SeeWhy YouTube channel. Now, I was in conversation with a student last week. They asked me, hey Jason, that's me, how do I access that Investment Basics series of videos on YouTube? So let me just quickly address that for all of you right now. Let me see if I can bring up a web page. There we go. Okay, so you guys should have a web page loaded on your screen in front of you. And I'm going to bring up SeeWhy YouTube, SeeWhy. Okay, very top link, SeeWhy Learning. And this is going to take you to our YouTube channel. Very good. Okay, let me just minimize this left side here for all of you. There we go. Okay, so we have a number of different videos, a whole bunch of them posted on our YouTube channel. If you scroll down, you can see all sorts of different topics, lots of things that we cover. There are 2 ways, though, that you can access the Investment Basics series of videos. The first way is you can just randomly go through this whole list here on the home page. Probably not the best way. So I'm going to show you the 2 other ways. All right. Under this section here, videos, this is one way that you can do it. You click on videos. And what you've got in here is all the SeeWhy Learning videos. And what you're going to do is you're going to look for things like Investment Basics number 1, and then Investment Basics number 2, and you guys get the idea, right? So we've got a whole bunch of different videos here from the Basic series, plus a lot of other videos as well. In fact, right here, this is for today's video. This is Bootcamp number 2. This was for last Monday's Bootcamp video here. Oh, the blooper reel. This is hilarious. I recommend everybody watch the blooper reel. It's only about 1.5 minutes, but it's our trainers. It's our trainers making mistakes and learning from our mistakes. So you guys can have a good chuckle at our expense on that one, okay? The other way, though, of getting access to the Investment Basics series is really simple. Go to this link here for playlists. I'm going to click on it right now. There we go. And the second option here, it says, learn the basics of investing. Okay, learn the basics of investing. Click on view full playlist. And what you now have come up on your screen is all the Investment Basics videos in order. And this is really handy. So as you can see, we've got an introductory video, number 1, 2, 3, 4, all the way down. We've got, let me see here, 12 learning videos. In fact, a 13th video as well at the very bottom, how to save money, what I wish I learned when I was in school. It's a good video to watch, okay? But one of the things you want to note is all these videos, they're very short in nature. I mean, this introductory one is 2 minutes and 41 seconds. Video number 1 is, 3 minutes, 35 seconds. I think, this one here is 6 minutes and 4 seconds. It looks like the longest is about 7 minutes. I've got, a couple of videos that are 6 or 7 minutes. That's about the longest. So it might take you maybe 1.5 hours to go through all these videos. But much like what I said last week, I promise, the worst that'll happen is you're going to learn something new, you're going to enjoy them, and you're going to come away with a better knowledge perhaps than what you do today. Okay? Now, while you're on our webpage, our YouTube channel page that is, do me a quick favor and click on that subscribe button. Okay, we're always looking for new subscribers through our YouTube channel. As we release new videos, as we release new content and new learning, you know what? You're going to have, access and notification about them right away. So definitely click on that subscribe button. It's going to help you. If you've got any staff or employees that might be looking for some help and learning and understanding the basics as well, maybe they're taking the mutual funds course, maybe they're not, they're just considering it. Again, it's a great resource and a good site for you to be at. Okay? All right, I've taken more than a minute talking about that, more than I planned. Let me just close this now. There we go. Okay. All right, so let's dive into today's agenda. Let's have a look at today's agenda and see what's on our plate today. Okay, there we go. There's today's agenda up on the screen. So today's agenda is going to be a little bit shorter than last week's. It's likely going to take maybe 15-20 minutes to go through. What we're going to do is we're going to start off with just a review of basics of investments, review the basics investments. I did talk about them from a very high-level point of view last week. We're going to do a bit of a deeper dive today, but it's more of a review of anything. Then what we're going to do is we're going to talk about investment portfolios really briefly, and so you'll have a good idea what investment portfolios really are and what they consist of. Finally, what we're going to do is we're going to take up just a handful of exam-level questions with our instructors. In fact, I'll take them up myself, and we're also going to take up how to approach solving questions. And I think that's a very valuable skill set, something that very, very few people actually teach you, how to solve questions and how to look at, these different kind of challenging things. All right. So let's get started right now. What do we have here? Review of investments. Okay, so we've got 5 items we want to quickly cover. Item number 1, what is a stock? Well, I talked about this briefly last week. If you simply imagine taking an entire company, breaking it up into little bitty pieces, and then selling those pieces off in varying amounts to different investors, that's really what a stock is. It's a piece or just a share of ownership of a company. Okay? Now, stock is also known as equity. Common stocks may pay dividends or they may not pay dividends. Right? They may have different classes of stock with different voting rights. Preferred shares, for example, may be issued with different dividend rates. So large companies may have more than 1 or 2 different classes of preferred shares available in the market. Your SeeWhy Learning study guide or your textbook, whichever you're using, will cover much of this material in more detail. Okay? So you do have to learn it and be responsible for it. But again, the SeeWhy Learning study guide or your textbook, or both if you're using both, we'll cover it in more detail. All right? What is a bond? Okay. So a bond is simply a loan to a company. In return, the company is going to make 2 promises to the investor. Okay, first off, the company will return the investor's money or principal at maturity. And secondly, the company will pay some kind of extra interest along the way for using the investor's money. And we call this extra compensation interest. All right. Now, a bond is also known as fixed income. That's just a fancy word for a bond. Now, it's important to note something in particular. A lot of people are going to use or have heard the word debenture, right? And they may use bond and debenture and wonder what the difference is. So, for everyday use, the words bond and debenture are the same. They're used interchangeably. But for exam purposes, you have to know the key difference. Okay? The key difference is this. A bond is backed by a claim against the company's assets, or perhaps a specific company asset, whereas a debenture is simply backed by the company's general creditworthiness, and it has no specific claim against any group or single amount of assets. Okay? Now, before I continue, let me also address this perception that some people have that all bonds are guaranteed. This is simply not true. All right? Bonds are not guaranteed. Let me give you this. Let's imagine this scenario. Let's imagine that your brother or your sister or your best friend approaches you and says, hey, can you loan me $1,000 and I'll pay you back? But until I do, you can keep my wristwatch as collateral. Okay, so if they don't pay you back, then the watch is yours to keep, and you can always sell it off, in order to try to get your money back, right? In this case, there's probably a good chance that you're going to get your paid, right? You're going to get your money back, well, unless it's a really ugly watch, okay? But if your brother or your sister or your best friend approaches you and says, hey, you know what? Can you loan me $1,000 and I promise to pay you back? But there's no collateral. It's important that you recognize that you're really only loaning the money because you trust that person. And there's no guarantee at all that you're going to get your money back. Okay? Finally, bonds have got different features such as callable, also known as redeemable, extendable, retractable, convertible, different things like that. So on your exam, you'll likely be tested on how these features work and which of them tend to favor more the issuer or which tend to favor more the investor. So you got to know those differences, right? Okay, what are cash and cash equivalents? So cash equivalents are investments that are considered so safe that they can be essentially converted to cash very quickly. So money market mutual funds are considered to be cash equivalent investments. So are treasury bills, so are GICs, things like that. Right? Now, a portfolio generally should have some cash inside of it, probably not a lot, right? It just depends. Because most cash investments will likely have very little in terms of actual return. Okay? What are derivatives? Well, derivatives are more complex investment products. They often combine both leverage and risk. And both of these concepts are discussed in our study guide, and I know that they're also discussed in your textbooks as well. In some derivatives, you can take the position of being the long, that is, the owner of the contract. And you may have rights or you may have some obligations depending on the type of derivative that you own. In other derivatives, you might take the position of being the short, that is the seller or the writer of the contract. And typically when you're the seller of the contract, you usually have some kind of obligation to the other party. Now examples of derivatives often include options, futures, and forwards. Okay? So what are mutual funds? What is a mutual fund? Well, each mutual fund is simply a combination of stocks and bonds and cash equivalents and sometimes derivatives too. Mutual funds will use money that's pooled together from many different investors. Right? Mutual funds will have professional fund managers that make decisions on your behalf. Okay? And they're bought from and redeemed back to whoever the issuing fund company is. Right? Now it's important to note that mutual funds are very popular because they can be bought or sold in small amounts. In fact, for many, many years, this is how many investors first started saving for their own retirement, is by using mutual funds. Okay? Now, mutual funds, they also come in all sorts of varying degrees of risk as well. So it's pretty easy to find something that's suitable for just about any type of investor that's out there. Somebody who's really conservative, or perhaps somebody that may be a lot more growth oriented or aggressive. Okay, let's talk about investment portfolios now, just briefly. So an investment portfolio is simply a combination of the different types of investments, a number of which we've already talked about. Okay? Investments are often recommendations that are made by an advisor if the client's working with one, right? Some clients may prefer to, do it themselves, and that's fine as well. Okay? The portfolio, though, is designed for the client's investment objectives, their risk tolerance, their time horizon, and it takes into consideration things like their investment knowledge, their personal financial situation, and any kind of unique circumstances that might be included as well. Okay? All right. Questions and answers. Questions and answers. So at this point, here's what I want to do. I kind of want to open this up a little bit to the entire group, all the listeners today first. Okay? And if anybody has any questions right now that they want to ask, now's a great time. I've got an application on another computer sitting beside me right now, and I've got one of my colleagues monitoring that application to see if any questions come up. So if they do, feel free to send them in. But I want to be clear, all right? There is no such thing as a dumb question. The only dumb question in my mind really is the question that doesn't get asked. Okay, if you got a question that's inside and you just don't want to ask it for whatever reason, ask it. Don't be shy. I mean, you don't want to walk into an exam not having had an answer for that particular question, okay? And what I'll do though is I'll keep that answer pretty brief, whatever answer it is I give, but I also make a point of keeping, this call focused on what's relevant to you and your learning and also to your exam as well, okay? And if there's no questions or topics that anyone wants to chat about right now, then that's fine. I do have, I think I've got 2 questions prepared for you that we'll cover in a moment. All right, let me just see if anybody has got questions right now. Let's see here. No, I'm not seeing any questions come up right now. That's fine. That's fine. Okay. All right, so just before I dive into those 2 questions, I promised you I do have a nice surprise for all of you that it's kind of my pleasure to share with you. So as a conversation with the other members of the SeeWhy management team, we know there's a whole bunch of people that are watching this webinar live, but we also know there's even more people that are watching this webinar as a recorded version in the evenings and some on the weekend as well. So for those of you that are not currently using the SeeWhy Learning study tools and you're studying on your own, we have a special coupon code that we're going to share with you today. Let me see if I can just bring this up on screen right now for you. Let's see here. There we go. There it is. Okay. Special 10% off coupon code. It's bootcamp10. No spaces. Bootcamp10. Valid for the next 24 hours only. Right? So I want to be clear again. Valid for the next 24 hours only. Now, for those of you that work for some of our big corporate partners, like the big banks, investment firms, life insurance companies, I want to be clear, we do offer corporate student pricing. That corporate student pricing is discounted. I'm not going to bring that up on screen right now. We have a special corporate website that you can access to take advantage of that pricing. But if you don't know how to access it, when you do work for one of those big banks or investment firms or life insurance companies, then by all means, please contact the SeeWhy Learning client service team. You can either give us a phone call or you can send us a message via live chat on our main webpage, and one of the members of our client service team will definitely get back to you on that. Okay? All right. Okay, so again, Bootcamp10, valid 24 hours only, starting right now. Okay. All right, let's have a look at how to solve questions. Let's have a look at how to solve questions now. Okay, so a lot of students truly don't understand how to solve questions on regulatory licensing exams. I mean, regulatory license exams, they're not designed to pass you. You've got to demonstrate that you can pass it, right? So these questions are often hard and sometimes are intentionally confusing, right? So to be successful, you need to have a good process for solving questions. Here's how, okay? First, what you want to do is you want to RTQF. You want to read the question first and make sure to use an active process of reading. An active process of reading. What does that mean? Well, this means you want to maybe circle keywords in the question, maybe underline keywords, maybe draw a box or highlight keywords in the question so that you truly understand what the question is asking you, either to do or to solve, okay? Secondly, make a point to read each of the 4 answer choices, okay? And so you're going to read all 4 of them. You want to understand what all 4 answer choices are, and then you want to ask yourself, what can I eliminate? What can I eliminate, right? Narrow it down. If you had to randomly guess at 4 different answer choices, your chances of getting the right answer is only 1 in 4. What is that? 25%. If you could get rid of one of those answer choices, you've narrowed it down to 1 in 3, which is what a better odd is 33%. In fact, if you get rid of 2 of those answer choices and narrowed it down just to 2 choices remaining, you've now got a 1 in 2 or 50-50 chance of getting the right answer. And I'll tell you right now, I'll take a 50-50 chance any day of the week. That almost gets me to a passing score, right? Finally, once you've narrowed it down, of the remaining answer choices, simply choose your best answer and move on to the next question. Do this process Do this simple process for every single question on your exam. That's how to write a smart exam. That's how to get the best mark possible on your exams. Okay? All right, let's dive into those 2 questions right now. Okay, question number 1. What does it say here? It says, what does it say? It says, a 90-day Treasury bill was sold with an initial yield of 4.23%. Since the Treasury bill was issued, interest rates have fallen substantially. Which the following is true? A, the Treasury bill would trade at a premium. B, the Treasury bill would trade at par. C, there is no secondary market for Treasury bills. D, the Treasury bill would trade at a discount. Oh, this is a great question. Great question. So you know what? Let me switch over my tool here. Let me bring up my highlighter, or my laser tool rather. Let's see here. Okay. So if I was trying to read the question first and doing that active process of reading, I would probably circle that this is a Treasury bill I'm working with. Okay. I would probably circle, highlight, or underline that interest rates have fallen. Okay, rates have come down. All right. And then I would probably circle or underline or highlight that we're looking for what is true. What's true? So when I look at these 4 answer choices, that kind of tells me, you know what? Hey, 3 of these have got to be false, right? Only 1 can be true. 3 of these have got to be false. Okay. So this question really tests your knowledge of Treasury bills, also known as T-bills. Now, I know that Treasury bills are always bought at a discount and that they mature at their par or face value, and that the gain is considered to be interest income only. I know that. Okay? So I know that, well, let's look at the first one here. I know that Treasury bills can never trade at a premium. I mean, that basically, if a Treasury bill is trading at a premium and it's going to mature at its face value, that means the investor is literally paying to lose money. So I can eliminate A. A doesn't make any sense. I'll eliminate A. A is gone. Okay? Now, I know that Treasury bills are bought at a discount. So that, well, we can eliminate B as well, okay? The Treasury bill would trade at par, all right? So it doesn't make sense to invest in something if all you're going to do is get your own money back. There's no return or incentive to invest, okay? So if something's trading only at par and you have no potential for profit, I can probably eliminate B too. So A and B are gone. It's now narrowed down to C or D. This is looking very positive for me so far. Number C, what does it say? This says there is no secondary market for Treasury bills. Okay, well, Treasury bills, I know, can be bought or sold to other investors at any point prior to maturity. So there is a secondary market, right? There is a secondary market for Treasury bills. So I can eliminate C as well. That's gone too. So A, B, and C are eliminated. I've already narrowed it down to D, but let's do D anyways. D says the Treasury bill would trade at a discount. Okay, well, you know what? That's got to be the correct answer. So I want to be clear though. If interest rates decrease, that means the price of that Treasury bill, just like a bond or a debenture, would also increase. So the price would go up, but it would not increase above its face value. Right? So no matter what, that Treasury bill would still trade at a discount prior to maturity. Yeah, that makes sense. Okay, let's find out that's the right answer. Let's find out. It's the right answer. Very good. I want to be clear though. What you saw was read the question first using an active process of reading. You saw using a process elimination on all 4 of those answer choices. And then you saw me demonstrate some of my knowledge of Treasury bills. And at the end of the day, that's the whole point of your studies. All right. Okay, let's go on to the next question now. Question number 2. Question number 2. What is this one about? Oh, okay. This looks to be about derivatives. Okay. All right, so let's read this question. It says, the current stock price of ABC is $30 per share. Amanda thinks ABC will increase in value to $45 and she has $10,000 to invest. What option strategy would be appropriate assuming her prediction is correct? Okay, and you got 4 answer choices. She should write a put option. She should write a call option. she should buy a put option or she should buy a call option. Okay, so this question is all about options. You know what? If I'm reading this question first, I would probably identify here that it's looking for an option strategy. That's what we're looking for, is an option strategy. Okay, I'd also want to know what her prediction was. Now, her prediction is very simple. It says she thinks ABC will increase to $45. It's currently $30. She thinks it's going to go up to $45. Okay, so you know what? This question is testing your knowledge of options and how they work. Guys, let me be clear though. This is definitely a tough concept. This is a tough concept. This is the kind of question in an exam that can really confuse, even people that know and are comfortable with derivatives, right? I'm going to start off by bringing up the SeeWhy options call put table and just briefly talking about it before I go through through these 4 answer choices. Let me see if I can bring this up on my screen. Let me see here. Let me see. I hope this works. Let's see. There we go. Okay, I've got it on the screen. Okay, now, in your mutual funds study guide, they should have a table like this, very similar to this. This came from one of our study guides. I can't remember which one, but it's always going to look the same. This is your call put options table, and what you have here on the left side of this table, you've got the call holder. They're the buyer of the option. And you've got the put holder. They're the buyer, again, of the option. When you're the holder, it means you're the buyer. Another word for holder is the long. Okay? On the right side of the table here, you've got the call writer. They're the seller of the option. And the put writer, again, the seller of the option here. So a seller, a writer, also known as a short. Okay? So the 2 quadrants, the 2 boxes here on the left, they're the long, they're the buyer. The 2 boxes here on the right, they're the short, they're the seller. Okay? Now, I'm not going to go through the call put options table in detail. You could practically watch a video on that whole thing. In fact, you know what? That's a great idea. I should probably build a video on a call put options table. That's a good idea. I'm going to put that on my notepad and do that. But more importantly, when you're long a call, what you're doing is you're hoping that the stock price is going to rise. It's going to rise. It's going to go up. Okay? And so this is a bullish strategy. Calls are a bullish strategy. Buying a call is a bullish strategy. Okay? That means when you're a call writer, automatically you're taking the opposite kind of position. This is a bearish strategy. When you're long a put, you're hoping that the stock price goes down. And what you're going to try to do is try to make money on that decline in the stock price. So somebody that's long a put is bearish on that stock. They're hoping it's going to go down in value. And somebody, of course, that's writing that put option, they're taking a short position. They are, of course, hoping the opposite. It is a bullish strategy. Now, the way I like to remember this is really simple. Okay, I'm not a really smart or complex guy. I try to keep things as simple as possible. Calls, you want to go up. Puts, you want to go down. So if it's a long call, it's bullish. If it's a long put, it's bearish. And whenever somebody says they're short, I just do the opposite. So a short call is bearish and a short put is bullish. That's the way I like to remember things. Okay? But now that we know what's bullish, what's bearish, let's keep that in our head and come back to the question. Let's see what happens. Let me just minimize this. There we go. Okay, so we're back to the question right now. All right, so Amanda thinks that ABC is going to increase in value to 45. She wants it to increase in value. That's bullish. That's bullish. That's what she's predicting. So we're looking for some kind of a bullish answer. Okay? We're looking for a bullish answer. So keep the following points in mind. An options contract is kind of like a bet. As with any bet, there are 2 parties involved, and each party believes opposite things. And just like any bet, only one person is going to be correct. So the investor that's correct will make a profit, and the other party, well, they're going to lose, right? So they'll probably be out of pocket. Okay? So Amanda thinks that the price is going to go up. She's bullish. Let's figure out which of these answer choices are bullish and which are bearish, right? And hopefully you've had a chance now to kind of think about that, call put table that we just saw, let's review the answer choices together. All right. So she should write a put option. She should write a put option. Okay, writing a put option. Let me see if I can bring that up again. Put writer. Writing a put option is a bullish strategy. Oh, that's good. Okay, so this could be an answer. That could be an answer. Maybe I want to, put a small tick mark or check mark beside that because that could be an answer. It's bullish. Okay, and it matches what we're looking for. But let's keep going through the other choices as well. All right. B says she should write a call option. Well, writing a call option is bearish. Okay. Here's your call writer up here. There's your call writer. It's a bearish strategy. So I know that's not what we're looking for. So I'd probably put a small X beside B because that's not the right answer. Okay. C, she should buy a put option. She should buy a put option. Okay, so that's a long put. That's a put holder. Let me see here. Buying a put option. Here's your put holder. She's the buyer of the put. It's a bearish strategy. Okay, so that's not what we're looking for. I'd probably put another X beside C again. At this point, A is a potential answer. B and C have both been eliminated. Let's have a look at D. Okay. D. Okay, so she should buy a call option. Buy a call option. Okay. Buying a call option. Here's my call holder. It's the buyer of the call. It is a bullish strategy. That is another potential answer choice. So again, I've narrowed this down now to either A or D. All right, it's either A or D. So we really need to put our thinking hats on right now. While writing a put option is a bullish strategy, the maximum profit that could be earned would simply be the amount of premium received when writing that option. So the profits themselves are limited. Okay, the writer of the option only gets to keep the premium that they received, assuming the option expires worthless, and that's it. All right. However, buying a call option is also a bullish strategy, but it's a bullish strategy that will maximize the amount of profit she'll make if her price prediction is correct. So what I'm going to do is I'm going to wisely eliminate A and choose D as my answer. Let's see if I'm correct. Let's see here. I am. Very good. That's a challenging question, that one. You know what? I'll be clear. It's important for your exam that you know that call put options table. Know that options call put table. It's certainly going to help you a fair bit. Okay. All right. Let's move on to the next one here. Do I have another question? No, I don't think I have another question right now. Wait a minute. I do have another question. It just came in. Why do bond prices go in the opposite direction of interest rates? Okay, so I just had a young lady ask, why do bond prices go in the opposite direction of interest rates? You know what? That's a great question. That's a great question. Let me address it for you right now. And this comes down to knowing your fundamental bond pricing principles really well. Okay? I'm gonna address that by kind of making a bit of a wild example. All right? Let's say a bond is issued at a coupon rate of 5%. All right, 5%. And that was just issued a few years ago. All right, 5%. And let's say today, market interest rates have gone up to, 20%. Market interest rates are now at 20%. So any bond issuers trying to issue a bond today would probably be issuing around the 20% mark. So if you were an investor looking to buy a bond, what would you rather have? That old 5% bond that only pays you 5%, interest from that coupon? Or would you rather have that 20% bond that pays you 20% interest? Yeah, I'm pretty sure all of you are answering, I'd rather have that 20% bond. I know I sure would too. Okay? So how does this 5% bond be attractive in the market? Well, it's really simple. Okay? What they do is they lower down the price of the bond, and so that the yield of this bond is yielding close to or at that 20% level, right? The price of the bond goes down, and so this bond yield will now increase close to 20% where this other bond is. And so all things being equal, if you're an investor looking at these two different bonds, you could, buy this bond, for 20% interest, or pay, buy this bond at a significant discount and get a yield really close to what this bond is as well. And so all things being equal, either one of these bonds would then be attractive to you. That's how that works. So as market interest rates rise, bond prices come down. All right, that's an inverse relationship. It's an inverse relationship between market interest rates and bond prices. Now, the same thing happens when market interest rates come down, bond prices go up. Right? So I kind of think of it much like a teeter-totter. I know kids' playgrounds may not have teeter-totters anymore, so hopefully some of you will understand exactly what a teeter-totter is, but it's got an inverse relationship. So as market interest rates go up or down, the bond price always moves in the opposite direction. That's a great question, and thank you to whoever asked that question. Okay? All right. Let's, I don't think I have any other questions right now. No, I don't see any other. Let's see what's next. Okay, so what's next? Make sure to keep track of your progress using the SeeWhy study schedule for your course. Guys, you know what? That is a great point. In fact, I want to show all of you something right now. I just brought this with me. Hopefully you guys can see this. Okay. This is the study schedule for the IFC, the Investment Funds in Canada course. This is the course offered by Canadian Securities Institute. As you can see, I've got all of week one's activities, check marked. They're ticked off. So if you've been following along with the study schedule, that's probably a great way of making sure that you're keeping on track with it as well. For those of you that are working with the IFC Institute, CIFC, Canadian Investment Funds course, I've got their study schedule in front of me as well. As you can see, I've got all of week one's activities ticked off as well. Okay, this is how you keep on track. You know what? Let me be clear. You ever played sports? Anybody that's ever played sports, whether it's an individual sport like swimming or soccer, swimming or tennis, or a team sport like soccer or baseball, or one of my favorite sports, rugby, anybody that plays sports know that you don't go into a game without a game plan. And that's the whole point of those study schedules. That's your game plan for successfully completing this course. Okay, so if you haven't downloaded or printed off the study schedules, go to our website, seewhylearn.com/bootcamp. Those two study schedules, we're giving them away for free, complimentary to this course. Make sure to download them, print them off, keep them with you. But, tick off the activities as you go through. They're going to help to keep you on track. Okay? Finally, my next point I want to make here is this. If you do have an active subscription, please book a complimentary one-on-one session below. There's a link for it, seewhylearn.com/bootcamp. But again, I want to emphasize space is limited. It's first come, first served. I had a number of great, discussions and conversations last week with some different students. I know some of my other colleagues, Andre did as well. I think Corey did too. We've got lots of space. So definitely, if you've got an active SeeWhy subscription, you need help, and you're using this series to help get you motivated, and stay on track with your study schedule, then by all means, book that one-on-one session. They are limited to 15 minutes each. But you know what? Like I said before, there's no dumb question except the one you didn't ask. So be sure to do that. All right, guys, that's all I have for you today. Thank you so much for joining us. Please enjoy the rest of your day, and I look forward to seeing all of you again next week, same time, same channel. Take care.